Yeah. Surprise, a little different than you used to. Yeah. Dropping these bars on YouTube, knowledge I introduce you. Yeah. We chasing this money like it's the prize, it's the voodoo. Fugazi, fugazi, it's just a lie we buying into. We need some cars on deck. Get the rollies, get the Moe, all the Mars on deck.
All right, welcome everyone. Thank you so much for joining this live stream this evening at 6:30 on a Thursday. Show some dedication by you all for joining. So thank you so much. There has been a lot. Obviously, I've covered quite a bit of mortgage rates, what's going on in the mortgage markets, quite a bit over the past week. And so what I wanted to do is kind of talk a little bit more about that. I know that there is a lot of uncertainty at this point in time. In opposed to me just talking as I normally do, I thought it would be worthwhile just bringing on maybe someone who actually works within the space currently. And so I'm going to introduce my guest in a moment. We're just going to talk about what's going on at the minute. We'll also try to explore roughly what the interest rates are. Now, just as a warning, we can't be prescriptive in terms of specific interest rates because a lot of the time there are so many variables in it. So your loan to value, your credit score, all those kind of things will kind of feed into this picture. So when we quote what mortgage rates that might be out there at the moment, just please take that with a pinch of salt. That doesn't mean that you're going to be able to get X rate. You're going to have to go through a mortgage advisor, and for me is actually a mortgage advisor as well. So there we go. That's just a couple of things right off the bat right here. I will open up for questions from you guys as well. So if you do have questions, then by all means use the chat function as you always do to pop in your questions, and we'll get round to those at some point during this stream as well. Just a couple of other things. On Sunday evening, I will also be doing another live where I'm going to have a guest as well, and it will be about overpaying your mortgage. Is it something that maybe you should be considering? Because I'm going to be completely honest, I've started to look at this very, very differently now, purely because my fixed rate actually comes to an end in October. And I'm currently in that position where I can start shopping around right now. And I'm coming off a 1.49% fixed rate. And my mortgage payments are going to increase. So one of the things that I'm thinking of doing is effectively overpay my mortgage slightly so that I can get into a more manageable monthly payment, as opposed to, going up quite considerably. So that might be an option that you may be considering. I'll have a guest on Sunday with a treat as well that may be of use for you. So what I want to do, without further ado, is I need to swap over a couple of things here, and forgive me if it doesn't work right first time. This is the first time I've done this using this piece of software, so it will be a little bit of trial and error. But let me just, how do I do this? Let me do this first, and then I'm going to go over to there. Let's see. There we go. And add. There we go. Cool. Wasn't as smooth as I liked. There you go. Practice. For me, thank you so much for joining the live stream this evening. Thanks for your time as well.
Thank you very much for having me.
Awesome. So can we do a brief introduction to you and what you essentially do before we get into what's happening and what you're seeing in the mortgage space, just for the benefit of everyone that's watching?
Yeah, absolutely. So as Pete said, I'm Fumi. I'm a mortgage advisor. I actually have a long background in finance. I've worked in financial services for over 20 years. For the first 19 years of my career, I was actually a lawyer, and I worked in legal and also compliance. And then a couple of years ago, I left the law, although I'm still a qualified lawyer. I left the law and embarked on something a bit different. So previously, I've kind of been working for, in organizations and in law firms, and I wanted to do more work with individuals, basically, more face-to-face, customer-facing work. So I trained to be a financial coach, and I was coaching and helping people with their money management. And one of the things that kind of kept on coming up quite frequently was that one area where people kind of struggled and thought there was just like not enough information or not enough accessible, understandable information was how to get on the property ladder. So I thought, okay, well, what can I do to help people? So I thought I would retrain to become a mortgage advisor. So I did that, and I've been a mortgage advisor since last year.
Awesome. I didn't know you were in law beforehand. That's actually, I've learned something as well today. So, how are you finding things at the moment in the mortgage space? Obviously, there's been a lot of uproar and uncertainty, panic, I would say, a little bit around where interest rates are going to go because of the Bank of England saying that they're likely going to push to 5.5%. What's it like for you on the ground, working in the mortgage space right now?
Yeah, I mean, you've used the word panic, and I actually got an email yesterday where the person that was emailing me said, I'm panicking because I'm about to try and remortgage, and all I'm hearing and all I'm seeing is this negative news about interest rates increasing, and I'm really worried that I'm not going to be able to afford, the mortgage that I'm going to go on to. So there is a lot of panic, there is a lot of fear amongst people at the moment, both people who are trying to get onto the property ladder for the first time, but then also people who are already on the property ladder, but they've got a particular product, like a fixed rate product, and it's coming to an end, and they're going to be in that sort of remortgage arena. I guess what I would say is, particularly over the last sort of week to 10 days, there has been a lot more activity and movement, unfortunately, movement upwards in terms of interest rates. And this is primarily off the back of the most recent inflation figures that were announced. So inflation is, the rate of inflation is reducing. So it came down from, I think it was 10.1% to 8.7%.
Yep.
So it's moving in the right direction, but it's unfortunately not moving as quickly as was expected or as predicted. And that then means that there is the kind of very real risk, I would say, that in order to kind of encourage it to move more quickly downwards, the Bank of England is looking at, or is probably going to be looking at, increasing the base rate. So there is a correlation between inflation and the Bank of England base rate. And the Bank of England can use the base rate, or they try and use the base rate as a way of kind of controlling and almost manipulating inflation. The theory behind it is that if you increase the Bank of England base rate, it makes the cost of borrowing more expensive. And people borrow to buy things. So if you kind of want to stop people or reduce people borrowing and spending lots of money, you increase the cost of borrowing. So the theory is you increase the Bank of England base rate, the cost of borrowing becomes more expensive. People are less likely to are less likely to buy things and spend money. And instead of spending and borrowing, what they'll do is they'll instead save. And the theory behind is that then helps to bring down the rate of inflation. So that's kind of what's behind all of this. Now, linked then to the Bank of England base rate is mortgage interest rates. And actually, the main influencer for for fixed mortgage interest rates, actually, I should say, because there is a difference between fixed interest rates and variable rates. But the majority of people, I think it's about 75% of people who have mortgages actually do have fixed interest rates. And the fixed interest rates are more influenced by something called swap rates. And what we have seen in the swap rates is that they're starting to go up, or they have been going up. And so the cost of funding for the banks is going up, and then they're looking to pass that on to us as consumers. And what I've seen, particularly in the last few days, I mean, even today, I had a lender that did it, is that lenders are trying to react really, really quickly. And when they don't know what to do, they don't know how to price their products, they withdraw from the market. So people have probably heard in the press that certain lenders have withdrawn from the market. The aim of the lenders is to kind of withdraw and then come back again, but with a different rate. But it does, I can see how it's very worrying when you're hearing a lender's withdrawn, or it's actually multiple lenders. And then when they do come back, the interest rates are higher. So that's kind of what we're dealing with at the moment. Unfortunately, sometimes not very much notice is given. So there's one particular lender today, we got an email around about 10, 11 o'clock to say that the rates were going to be withdrawn at 5 o'clock. And that's when you've got to get your application in to try and secure a rate for a client. And actually for this particular lender, all of the mortgage advisors obviously were trying to get the applications in. People were waiting for hours just trying to log on. They ended up withdrawing even earlier than the 5 o'clock that they told us, because they were just jammed and they couldn't deal with the demand. So that's kind of what we're working within at the moment.
Yeah. So just some context I think is important here as well, because I think the number that was banded around in terms of products that were poured, I think this is probably about a week ago, was 800 mortgage products roughly. But I think it's important to note that there are quite considerably more mortgage products generally out there in the markets, and they are in the thousands essentially. So I think
That's right.
that's important just in terms of a little bit of context for people watching to say, yeah, 800 sounds like it's a large amount, but actually there's so many more other mortgage products in terms of the numbers and volumes available out on the market. I don't know how that breaks down within fixed or standard variable or tracker deals or anything like that, offsets or maybe, but I think that's really important to know. Another thing you mentioned as well, and I'd love to get your thoughts on this. Sometimes when this happens and there's a little bit of uncertainty around what's going to happen with the bank rate, I think it's fairly typical that we often see panic and then rates start to move quite a bit. But once we kind of know what's likely to happen, sometimes it does calm down. Do you think that is something that is likely to happen as more comes to light around what the Bank of England are going to do in terms of the next round of increases, if they do any in the next one, or whether they decide to hold off?
Yeah, I would like to think so. And I guess what we're kind of experiencing at the moment feels a bit familiar. Back in sort of October time last year, we had the mini budget, and that caused a spike in the swap
Yeah.
rates. And then we saw a similar situation where we saw mortgage interest rates rise quite significantly and quite quickly. And what we then saw was that there was the period afterwards where there was that sort of volatility and fluctuation. But then they did start to sort of settle. And we came
Hmm.
into this year, and actually the rates were sort of going down because the swap rates were going down because there was more sort of, I guess, certainty around what things were going to look like. So I'm hopeful that we're going to see something similar. Yes, at the moment there is volatility and fluctuation, and lenders are, considering and they're repricing their products. But my hope is that when there is a bit more, I guess, certainty around what the base rate is going to look like in the medium to short to medium term future, that starts to settle. And what we often see is that the increases in rates that we're seeing now, lenders can be pricing in for any sort of expectation of increases in the future. So hopefully we'll get to a point fairly shortly, I hope, where actually it will start to settle. Hopefully we're not going to be in this sort of state of flux for a very long time, because it's not good for anybody. It's not good for consumers. It's not good for brokers. It's not good for the industry to have this kind of unsettled environment.
Yeah. Okay. That's a really good point. I wonder if you can touch on very, very briefly. You mentioned there that about 75% to 3/4 roughly of most residential mortgages or mortgages generally are on fixed rates. And obviously everyone knows that with a fixed rate, it allows you to budget, it allows you to know that your payments are set at a certain rate for the term that you basically fix it in for. What are the pros and cons, I guess, of perhaps someone looking at things right now thinking, I'm not really liking the rates that I'm seeing out there at the moment. I might just settle for maybe something like a discounted or a tracker or something like that. What are the key considerations with that?
Yeah. So, I mean, everyone's situation is going to be really different. Everyone's going to have different needs, different wants, different things that they're sort of looking to achieve. If you are somebody, like you said, who sort of looked at the fixed rates and think, it's not for me at the moment. Yeah, like you said, there are other rates they can consider. I guess if it's not a fix, the concern is that it's not fixed. So it makes it more difficult to budget. So even something like a discounted rate. So for people who aren't quite aware what that is, that's when a lender could say something like, it's a 1% discount on our standard variable. The standard variable rates are generally the ones that, if you look at all of a lender's rates, there's lots of different types. A standard variable is generally the one that's the highest, right? So generally from a mortgages perspective, we've usually been trying to encourage people, don't sit on your standard variable rate for too long because it's normally the most expensive. But lenders have something called a discounted rate where they might do a discount from that standard variable. Now, it's a discount from it, so it's going to be cheaper, but it's a lender's variable rate. So the lender has the ability to increase that rate or actually decrease it. So if they're increasing the rate, it's not great for you as an individual, because it means that, yes, you're paying a lower amount of interest than if you were paying the actual rate itself, but it's still going up. If they decrease the rate, then yeah, that's good for you, because then it's going to be less. But there is that risk, and that's kind of out of your control. And a lot of people, particularly when it comes to their money, they want to have some sort of control. If being out of control causes, discomfort and uncertainty. But there are some instances where it might be right in a particular scenario to not fix and look at some sort of variable like a discounted rate. It really just depends on your circumstances, and also how much, I guess, tolerance for how much risk appetite you have. There are some people that I speak to, they will not sleep at night if they don't know exactly how much their monthly payments are going to be each month. If you're one of those people, it's unlikely that anything other than a fixed rate is going to be the right thing for you. You don't want to be worrying about what you're going to be paying for your mortgage, every day. So there's those people. But then there's some people that maybe they've got more disposable income, so it's not as much of a concern for them, and they have more of a tolerance for risk. So they think, you know what, I'm just going to tough this out for a few months, and then I'll see what the market's like in a few months. And then if the fixed rates at that point look more attractive, then maybe I'll go with that. So it really is very individual.
Excellent. And I know you can't be prescriptive with this next question, and it might be a really difficult, almost impossible one to kind of answer. But in that example that you've just given there around, discounted offerings, mortgages, how different are you finding the rates between, say, a discounted, a fixed rate at the moment? Is there a huge chasm, or is it minuscule in terms of a difference in terms of the rate that's offered?
It's really hard to say, because it depends on so many different factors. So, for example, yesterday I was looking at a particular discounted rate, and it was the standard variable was 7.99%, and it was a 1% discount. 7.9%. Yeah, and it was a 1% discount. So if somebody was on that particular rate, they would have been paying 6.99% at that time. But obviously, if the lender moved their standard variable rate, then obviously the rate that you were paying would also increase. So
I'm still a little shocked at 7.99%.
That's not the highest I've seen when it comes to standard variables at the moment.
You're joking.
I'm not joking.
What's the highest you've seen?
I've seen an 8.49.
Wow.
Yeah.
Oh, wow. So actually, this puts things into context, though, because people are saying, fixed rates at 4, maybe 5% is expensive, but in comparison to what? And I think that's always the key thing. Expensive in comparison to what? Because 8.49 or 7.99% on a standard variable, jeez.
Yeah, that's why, we're saying to people, if you're coming to the end of your fixed rate, whenever I contact any clients, I don't just say you're coming to the end of your fixed rate, let's have a chat. I say you're coming to the end of your fixed rate. If you don't do anything, you're going to roll onto the rate, and the rate is this. And based on what your balance is, your payments are going to go from this to this if we don't do anything. I think we really need to spell it out to people, because they may not really appreciate what that means. And I think the point you made is absolutely right. It's in comparison to what? Rates, we had a period of time, a very long period of time, where rates were very, very low, and they were low in comparison to what they've been in, the history of rates. And for a lot of people, that's maybe all they knew. So it does probably feels very unfair and very frustrating for a lot of people, because that's all you've known. You've known rates of 1% and 2%, and even 2.5% at some point might have felt a bit high for you. And now you're in a scenario where potentially it's 4 or 5%, and that feels very high. But if you kind of zoom out and you look at the history of mortgage interest rates over decades, that sort of 10, 11-year period where they were really, really low, it was a long period in the sense that it was 10 or 11 years, but actually in comparison to the history of interest rates, it was actually quite a short period, and it wasn't the norm, It really wasn't.
Yeah. And guys, if you watch any of my previous live streams where I've been talking about mortgage rates specifically, I've actually gone through a chart looking at past mortgage rates, and like in the 80s and the 90s there were double digit interest rates out there. And to be in a period where for the longest time we had, even my 1.49% fixed rate mortgage, I couldn't believe it when I got it. I was like, really, is this low? It's not the norm. And I think we're coming out of that transition now to maybe a higher rate interest rate environment, and that's what we're going to have to get used to moving forward, really. And I think we need to be prepared for that and not kind of kid ourselves into, oh, rates surely are going to go back to what they were. I like to say, look, if it does, great, but prepare for the worst and hope for the best is kind of what I'm saying to people, so that you can look at it from a pragmatic point of view.
Yeah, I think, if I'm honest, I think the rates that we're seeing now, sort of the 4 and the 5%, I feel like potentially this is going to be our new normal. So our normal for however long, from sort of like 2009, 2010, for a good 10 years, was maybe sort of the low, the ones and the twos at a push. That was the norm then, but I feel like it's a new normal now. And it's something that unfortunately we do have to deal with it, because there's nothing we can really do about it. Now, obviously, if you're somebody who's coming off a fixed rate that was quite a low fixed rate, and you're now looking in the market and the interest rates look very different, so that means that your monthly payments are going to go up. There are things that you can do, things that you can look at to try and make it more affordable for you. So things like, and this isn't typical mortgage advice. Normally we wouldn't be encouraging people to do these things, but ultimately we need to make sure that you can pay your mortgage. Okay, missing payments or not being able to pay is not where we want to be. So there are things such as, for example, and they won't work for everybody, but this is why I say and I would echo what you said, go and speak to a mortgage advisor who can sort of talk you through the different options and see what would work for you in your scenario. But you could, for example, think about extending the term. So let's say you've got 20 years left on your mortgage. And if you were to remortgage on 20 years, that would mean that your monthly payments would increase to an amount that was unaffordable for you. You could look at them maybe extending that period out, maybe to 25, maybe to 26. And actually, one thing I would always just say to people is, often when we talk about terms, we talk in 5-year increments. You can actually pick any term you like. So it could be 20, 21, 22, 23. So a mortgage advisor can run the numbers for you and can show you, okay, if you extended it out to 22 years, this is what the monthly payments would be. This is what the interest would be, because you're going to end up paying more interest overall, because you're paying interest over a longer period of time. But it might be that for a period of time, that makes it more affordable to you. If you were to then pick a product, let's say, I don't know, a 2-year product or a 5-year product, at the end of that term, you could then look and see, actually, do you have more money? Have you started to earn more in your job, for example? And then could you try and reduce the term down so that you're then bringing the term in again? So that's one thing you could look at, extending the term. Another thing you could look at is potentially for a period of time, you could maybe think about going to interest only, or part interest only, part repayment. And that's something that a lot of people don't know that you can do. Now, it does depend on the amount of equity you have in your property, so the amount of property that you own, but that is another thing that you can look at to potentially make the mortgage payments more affordable for you. So there are options. You might not like all of them, but if you really can't afford to pay, and if you've looked really closely at your income and you can't increase that anymore, if you looked at your expenses and you can't reduce that anymore, then you may need to consider some of these options. Like I said, the most important thing is being able to keep paying your mortgage, whatever it is that looks like.
Yeah, and you know what? I love those options there, particularly the option of perhaps going part interest only, part full repayment. And the reality is, you're not going to know what the choices are until you have a conversation, until you actually ask the question. And this is where maybe I thinking with my financial services hat, I get slightly frustrated, because it's like, go speak to a mortgage advisor, but people often feel very, very reticent to speak to a mortgage advisor, because I don't know, there still seems to be this little bit of a, I guess, aura about being, I don't know, unapproachable, or something that is too difficult to do. And I think it's time well spent just to be able to explore all of the options that are out there.
Yeah, I absolutely agree. And just to that point, like I feel the same way. I think it's a real shame that people are potentially really worried about this, but then aren't speaking to anybody. You know, we're normal people, most of us. We're normal, so we understand that this is a really kind of worrying time for a lot of people. As I mentioned when we started, I had a message yesterday where somebody talked about, I'm panicking. I had another message recently where somebody said, I'm so scared. Like, we get it. We know that, it's bricks and mortar, but actually it's more than that, right? It's your home. It's your place of security. It's your place of safety. It's where you raise your family. Like, we get it. Like, it's really, yes, it's practical, it's numbers, but it's also really emotional, and we get it. And like, if you find a good mortgage advisor that you can talk to and you can be really open with and you can be really vulnerable with, we honestly, I promise you, we will do our best to help you.
Brilliant. I want to ask you about I haven't seen too many of them around, and they used to be really, really big. And I think maybe when there were better interest rates, which is where we're coming back to now, offset mortgages, because offset mortgages are a good thing. They allow you to retain some of the cash or capital that you might have acquired and set aside, still giving you access, but it allows you to offset some of that interest against your mortgage. Can you talk a little bit about that briefly for people who may have some capital lying around that they're just, sat in a savings account right now thinking, what do I do with it?
Yeah, I can. And actually, I've been working on an offset mortgage case this week, so I'm delighted to talk about it. So as Pete explained, so an offset mortgage is whereby if you've got a lump sum of cash that's maybe sitting in an account somewhere, maybe earning interest, maybe not. And as a complete aside, if you've got a sum of money in an account and it's not earning any interest, then please relook at that. But what you can do is if you've also got a mortgage, so just putting some figures to this, let's say you've got a mortgage balance of £200,000 and you've got £20,000 sitting somewhere. What you can do is you can effectively bring those two things together. So you can have a mortgage and then you have the money sitting in what we call this offset savings account or a linked savings account. And instead of the interest that's being charged on your mortgage being charged on the full 200, in that example, it would be charged on the difference between the 20 and the 200. So it'll be charged on the 180. And that can mean that actually you're saving interest. So the money that's held in the offset account, in that example, the £20,000, that won't be earning interest, but you'll be saving interest because the interest on the mortgage balance is actually now being calculated on the smaller amount. And it can actually save a lot of interest. So on this particular case, I was looking at, it was £195,000 balance mortgage, and the person had £25,000 in a savings account. So if we calculated, and there's calculations that again a mortgage advisor can do and can show you, we calculated that if they kept that £25,000 in there for the whole term of the mortgage, they would actually make a saving of £58,000 for that particular circumstance, right? Yeah. Now, obviously, you then need to work out, right, if that £25,000 was sat somewhere else and was earning interest, what would that interest be? And also, what would the interest rate would you be paying if it wasn't an offset mortgage? So there are a few calculations that you need to do, but I think it's definitely an option for people to look at. For people who've got some cash that they don't necessarily want to use it to pay off the balance of the mortgage or part of it because they want to have access to it, but they don't necessarily need it immediately. So for example, if you've borrowed money, let's say you're doing a renovation, right? So you've borrowed some money, but you're not ready to do the renovation yet. You might not be renovating for say 6 months. If possible, if you had an offset mortgage, you'd be able to then put that money in the savings account. And then for that 6 month period when you weren't using it, you could benefit from from that offset amount. So it's definitely something to look at. I think it's also particularly good for people if you're a business owner, if you have maybe set aside money to pay your tax, and your tax is just sitting somewhere, why not, if you can, use that money, keep it there. Let's say you're really diligent and it comes to the 6th of April and you've done your accounts for the previous year, you know how much you have to pay. But let's say you said, I'm not going to pay it until the 31st of January because I don't have to. So you've got a period of time where you've got just money, the tax money just sitting there. Make that tax money work hard for you, is what I would say. So yeah,
I
definitely
love
something
that.
to look at.
Yeah, absolutely love that explanation right there, and I hope that it gives anyone who's watching live, or if you're watching this on the replay, just a little bit of food for thought. Because again, these are options that you may not have heard about previously, especially if you're watching, YouTube. I definitely haven't seen that many videos on offset mortgages or anything like that. So hopefully, you find it as something that you can use potentially as an option for you. I was going to ask you a question, and it's literally just gone now.
I
I'll
have another
remember
point
it
to
in a
say about
moment.
offset mortgages, actually.
Go
Though.
on, go for it.
Yeah,
Go for
I
it.
was just going to say, and this is the benefit, I think, of going to see a mortgage advisor. So when I do initial consultations with clients, and I expect that this is the same for all mortgage advisors, I'm asking you questions about all sorts of things. And you might think, why is this woman randomly asking me questions about savings accounts that I have? It's because I want to find out if you've got money somewhere, because then I want to say to you, do you know what? There's this type of mortgage that could be useful for you. So this is why I say, if you're speaking to a professional, disclose everything. You might be thinking, why are they asking me that? But there's a reason behind it. And you might have never heard of an offset mortgage. And then you might think, actually, this is a really good idea for me.
Yeah. Okay. And this is the question I was going to ask. For the benefit of the users, how do the rates work on an offset mortgage? Can you fix them, or are they variable?
So the one that I was looking at recently, it was a fixed interest rate. So yeah, I mean, at the moment, the ones that I found were fixed interest rates. There may also be variable ones. I would probably expect there would be. But yeah, when I was looking for them this week, the ones that I found were fixed rates.
That's good to know. So again, hopefully this is something that you'll be able to use if you're actually watching this as well. In the general scheme of things, when it comes to, because I can only imagine you must be absolutely just rammed at the moment with people clambering to like fix mortgages and kind of find out what's going on at the moment. In the general scheme of things, what would be your hope for the next, 3 to 6 months as we head into summer and towards the back end of the year? Do you think things will calm down? What do you think will happen?
I mean, I really, really hope so, because it's just really, it's hard, right? It's hard for consumers. It's hard for brokers. I can't imagine it's particularly nice for lenders either, or people working within lenders, because they're having to do things quickly at short notice, under high pressure. It's not a nice time to be working through this. And actually, something that the process of purchasing a property, that for a lot of people can already be quite stressful and overwhelming, it's made even more so by the sort of current environment when it comes to the financing part of it. So yeah, I would absolutely hope that we do start to see things settle a bit, so we can it can just be a bit more pleasurable than it has been over the past week or so.
Yeah. I know that you said you find people are panicking at the moment. Are you just finding people who are just fed up as well in your interactions? Because I mean, it's horrible to think that we're in this situation. Because if you really think about it, for the past 3 years, we've had the pandemic, come out of the pandemic and think, hey, get back to normal. Then all of a sudden there's a cost of living crisis. And then just as that is about to subside, or just as it's getting to the peak where you think it can't get any worse, you start to see inflation start picking up. And then all of this starts kicking off with mortgages and all this kind of stuff. People being squeezed left, right, and center. I mean, you must have a conversation with people who are just kind of fed up and just like, it doesn't feel like anything's working anymore.
Yeah, absolutely. I think particularly if you're trying to get onto the property ladder for the first time, for a lot of people, it feels like the goalposts keep moving. They did the right things. They didn't spend more than they earned. They paid themselves first. They kept the debt low. They did all of the kind of standard, positive money management things that they were told to do. Yet for them, they get to the point where they think they're going to buy, and then for whatever reason, the goalposts have moved and they now can't maybe afford what they wanted to afford. So for those people, it is just sheer frustration that they're really trying, but it just feels like things are moving away from them and they're struggling to kind of keep up. For people who are remortgaging, yeah, it's just hard because effectively when you remortgage, you don't get anything different. You're just paying more for the same thing that you've already had. And
Yeah,
like you
yeah,
said, then there's other things. So, particularly people with young children, childcare costs, food, petrol,
yeah,
everything life just feels a lot more expensive. And, most people's wages aren't rising at the same rate as everything else is rising. So you just can't do as much with your money. And so it just doesn't feel nice for a lot of people. I guess, if I could offer any words, I would say it's not you. It's, there's nothing you've done wrong. It's things that are outside of your control. All you can do is control the things that you can control. Do as much as that. Be as informed as you can be. Speak to the professionals. And then I think we're just going to have to wait it out. I don't know if there's anything we could say, we could do. But one thing I would say, though, is for people, make sure that you're getting all of the income that you can get, because the number of people that I speak to, it's slightly off topic, but the number of people that I speak to, in fact, someone I spoke to yesterday, and the person that used the word "I'm panicking," I was talking to her about her income, and I was asking her about the different things that she receives because she has a small child. I said, okay, are you claiming child benefit? Are you claiming tax-free childcare? And then she's like, oh yeah, no, I didn't know about that tax-free childcare thing.
Mm-hmm.
And she could have been getting up to £2,000 a year for the past 2 years. So I think I saw a statistic, and it was something like, don't quote me, I think it was something like £19 billion worth of unclaimed government support.
Benefits, yep.
Yeah, so I would say to everybody, even if you don't think you'll be eligible, just have a look, because you never know. Your situation, the last time you checked, maybe the rules have changed, and now maybe you're eligible. So yeah, I think if there's money out there, I'm a massive advocate in getting it. That's why we pay our taxes. That money comes from the money.
Thank you so much. Right? Thank you so much. And this is the thing, right? So I've said this so many times with Channel 4 when I was doing the cost of living clinic. It's like, this is money that you've paid in as a taxpayer. In your moment of need, it is your entitlement to go and claim some of that money back. And I think the feedback that we always got week to week was, the system and the application process is so cumbersome, which it is. It's not easy. It's how it makes you feel. And I'm like, I get that. I completely get that. Some people feel as though they're scroungers if they claim it, but it's like, you've paid into this. Like, you've given your money for this. So it's like, it's your entitlement to be able to claim some of that back. And I think that's a really, really good point to make, that, there are lots of things out there to basically help you, and making sure that you're taking advantage of every single bit of help that you can find. And literally just go on to turntous.org. I think is a really, really good one. They've got a benefits calculator on there. Spend 10 minutes filling in the calculator. It will give you a breakdown of what they think you should be eligible for, and they can actually then take you through the process as well. So 10 minutes well worth spent. I do want to ask you a question, because you mentioned this a little bit earlier on, for first-time buyers. Now, I've been talking about the fact that you've quite amply described the situation that a lot of first-time buyers are facing. They've saved the deposit, or they're getting close to saving the deposit. They've done all the right things from a personal planning, budgeting, finance point of view. They've sacrificed. They've got to that point. Now, interest rates are going up, which means that, property prices might have fallen 4% since August, so the deposit might be a little bit less for the area that they're looking at, but now the mortgage payments are going to be even more. And then typically what happens is most of the lenders will tighten affordability for them as well. So things like childcare costs, credit card debt, those kind of things can impact then how much you can borrow. Can you talk a little bit about the affordability criteria, just broadly, so that people kind of get a grasp of how that actually works? And
absolutely. Yeah, sure. So generally, when a lender's looking at how much they're going to lend you, I'd say they look at sort of 3 to 4 main things. So the first thing to kind of work out what amount it would be is they'll look at your income. And that can be income from if you're employed, or income from if you're self-employed. And typically, different lenders may be a bit more, a bit less, but typically I'd say their starting point would be sort of between 4 to 4.5 times your income. That's the starting point. So let's say you earn £40,000 a year, you're buying on your own. They'll be looking at sort of between £160,000 to £180,000 as a starting point. And the second thing they'll look at is your expenses. So your committed expenses, so things that you need to pay. So it'll be like your bills, your water, your electricity, your gas, your council tax, all of those types of things. They will also then look at any other commitments you have. So that could be credit commitments. So credit cards, loans, car finance, things like that. And then, as you mentioned, also childcare costs. So they'll look at both of those, and then they'll kind of come to decide how much they want to lend you. They will also consider your credit history and how you've behaved with credit in the past. So how good are you at borrowing and repaying? If you're good, that's good. But if in the past, you borrow and then you're late, or you miss payments, or there've been defaults, that doesn't mean that they're not going to lend to you, but then it might just be that it might not be, for example, the lenders with the best rates. You might have to look at more specialist lenders who have particular products for people that have maybe had some credit blips in the past. And then the last thing they'll look at is how much deposit you've got. So they'll kind of add all those things together, and then that's how they will decide how much they're comfortable lending to you.
Brilliant. And that's a really good breakdown, because I think it's very, very important as a first time buyer. If you are a first time buyer, again, speaking to a mortgage advisor so they can actually run through the likelihood of what you're going to be able to borrow based on where you want to buy. And that gives you a proper picture of, right, I'm here from a realistic point of view. And obviously, please don't forget that, you're going to have things like solicitors' fees and all that kind of stuff that you also need to pay, because oftentimes people forget that. They really do. So and they get really excited. It's like, oh, there's an extra $2,000 or so that I need to find somewhere for solicitors' fees or so and stuff. So cool. All right. This is normally where I kind of allow people to kind of ask questions. There is one question in here, and I don't know whether you can answer this or not for me, but it was around, let me just get rid of this very, very quickly. Let's get rid of that. And let me see if I can just pop this up here. It was a question around what situation with buy-to-let mortgages, is it as precarious? I mean, buy-to-let obviously have different criteria in terms of your deposit levels and all that kind of stuff, and they look at different things, but do you have an answer to that at all? Do you have a view on that?
Yeah, I mean, what I would say is they are still around at the moment. Typically, I find that the fees for buy-to-let mortgages are generally higher than they are for residential mortgages, if there's going to be a fee attached. And also typically, I see interest rates being higher as well. As you've mentioned, the sort of deposit requirements for a buy-to-let mortgage are more. So generally from a, from a residential mortgage perspective, the starting point is normally at 5% deposit, and there actually are also mortgages where you don't need a deposit at all. But for buy-to-let mortgages, it's typically 25% deposit. There are some lenders that will let you borrow with a 20% deposit, but it typically is 25%. But no, they're definitely still around.
Cool, perfect. I would love to get your view on the whole, because I think we kind of discussed this at the KBM's event around the whole,
I know what you're going to say.
100% mortgages, and we were talking about how actually it sounds great, but actually the pool of people that are likely going to benefit from that, especially in places like London, is actually quite minuscule. And I think the providers have been very, very clever in terms of building and packaging that out. What's your view on 100% mortgages, aside from the obvious risk that, if you're going in 100% and markets dip, you've got a massive negative equity problem potentially down the road?
Yeah, and that is the main risk of this particular product. I think we're talking about the skipped and track record product mortgage here. That's the main risk. I would say to alleviate that risk, whenever I've spoken to anybody about it, because as you can imagine, when it came out, it created quite a buzz. So lots of people wanted to know a bit more about it. But everyone I've spoken to, I said, if you were to be eligible for this, and there's a lot of criteria that you need to hit, so you're absolutely right, it's aimed at a really specific group of people. But if you were to be eligible, the thing I always say to everybody is start making your overpayments from the beginning. So it's a 5-year fixed rate. So you've got at least 60 payments, right, to be making those overpayments. Start to build your equity, your ownership of that property as soon as. So when you're looking at, how affordable it is for you, don't be thinking of just the amount that you're paying each month as a mortgage. Build in the ability to make an overpayment every month to try and negate or minimize that negative equity risk as much as possible. In terms of what I think about it, sort of generally as a product, I think it can work for some people. For a lot of people, it won't work because the numbers just don't stack up. There's a calculator that you can look at. And when you put the numbers in for a lot of people, it gives them an amount of money, but they might not necessarily be able to afford the property that they want with that amount of money. So it definitely doesn't work for anybody. The best types of people that it works for, I've got a couple that I'm speaking to at the moment where it could potentially work. People that are paying like a high amount of rent relative to how much houses cost in their area. So I've got a couple who are paying something like $995 in rent. And when we put it in the calculator for 35 years, it comes out something along the lines of like £181,000 or something like that. Now, for them, they can actually buy the type of property that they want for that amount of money. So it definitely doesn't work for everybody, but it will work for some people. So again, if that's you, speak to an advisor, let them talk you through how it works and how much you can afford, and then you can see if it's the right option for you.
Amazing. Right, before we round this off, how do people find you? And by the way, I will put details for Fumi in the description and the comments section as well. I'll pin it. So if you do want to speak to her, because you've heard her speak to me here, you may be thinking she knows what she's talking about, you want to have a conversation. How do people actually find you?
Yeah, sure. So I can be found on an Instagram account. So it's Fumi_the mortgage mum, or you can just email me, and I'm fumi@themortgagemum.co.uk.
Excellent. I'll put all of that in the description. I know you got kids and stuff like that, and I know that you've carved out time in your evening for me to do this with me. So thank you so much. I know. It's all good. I'll let you go, but thank you so much for joining me.
Okay, darling. Darling. It's okay.
Cheers. Thanks, Mom. Oh, bless her. All right. Okay, cool. Let me just get this right again. There we go. Boom. Actually, the wrong one. Let me do that. This one. Okay. Right. So I hope that you found that useful. I hope that it was entertaining. Entertaining. I say entertaining. We try and make this entertaining, but more educational more than anything else, really, I hope. It is, I guess, a very uncertain time right now when it comes to mortgage rates. And if you are kind of in that place where you're kind of like, don't know what to do, you want to move house, you need to remortgage, you're trying to get on the property ladder, it's very, very easy to feel as though things are kind of conspiring against you and working against you. But I do think that we are in a moment right now where we're just having this shift. Interest rates have been very, very low for a very long time. I think we're coming out of that environment. And as always, whenever you experience a change that is quite a significant change and there are financial consequences to it, it's a hard adjustment to make. And so I think that if you are in a position where you're kind of uncertain, you're a little bit worried, go and speak to a mortgage provider. And I'll put all of Fumi's details down in the comments and the description down below as well. I've been following Fumi for quite some time on Instagram, and every single time I make any content around mortgage rates or interest rates or mortgages, she always messages me, and her responses are always really, really thoughtful. It's one of the reasons why I thought she'll be a great person to have on this live this evening, opposed to just anyone. I try to make sure that when I bring people on, they are also from my industry. They are qualified. They know what they're talking about, and not just trying to throw out hyperbole and just stuff that isn't generally going to be of any value to you. So hopefully you found this interesting this evening. Thank you so much for joining me. And we will have another live on Sunday evening. It is going to be all about overpaying your mortgage and some of the things to consider there. And some people, when you talk about overpaying mortgages, they automatically assume you need to have £5,000, £10,000 to overpay your mortgage. What we're going to be talking about is how you can do it with small payments. And I'm talking doing shopping at a certain place where money aggregates and you're able to use that to offset. And I've got a bit of a giveaway that on Sunday evening as well. So make sure you come along to that. It's going to be really, really interesting, similar to this one here as well. But I do appreciate you. I'm going to let you go. It's been just under 50 minutes. I will catch you on Sunday evening.
Yeah. Surprise, a little different than you're used to. Yeah. Dropping these bars on YouTube, knowledge I introduce you. Yeah. We chasing this money like it's the prize, it's the voodoo. Fugazi, fugazi, it's just a lie we buying into. We need some cars on deck. Get the rollies, get the Moe, all the Mars on deck.